Welcome to Talk Tickers. We cut through the noise of corporate reports to bring you the insights that, well, really matter.
That's the goal. Straight to the core information.
And today, we are diving deep into RTX's second quarter 2025 earnings.
Yep, a big player in aerospace and defense. We've gone through the call, the numbers, all of it.
Our mission here is simple. Get you quickly up to speed on their results, the strategy behind them, and what it signals for the market.
Think of it as your guided tour. Let's hit the highlights first.
Absolutely. Let's get right into that results snapshot. So, top-line adjusted sales came in at $21.66 billion.
Which is solid. And importantly, that's 9% organic growth year over year.
And the commercial aftermarket piece, that was up 16%. Pretty strong continuation from Q1, right?
Definitely. That recovery seems to have real legs.
Yeah.
And it wasn't just sales. Profitability looked good, too.
Okay, tell us about that.
Segment operating profit climbed 12% year over year, reached $2.7 billion.
And that was across the board, all segments contributing.
Yeah, growth across all three, which boosted their consolidated segment margin by 30 basis points.
30 basis points, so 0.3%. Doesn't sound huge, but for a company this size.
Exactly. It signals better efficiency, better operational leverage. It adds up.
Got it. And earnings per share. Adjusted EPS.
Came in at $1.56. That's up 11% from last year.
Okay, $1.56. But wasn't there a tariff impact in there?
There was, yeah. But a 6-cent hit from higher tariff costs baked into that number.
And the GAAP number, just for completeness.
GAAP EPS from continuing operations was $1.22.
All right, now cash flow. That's always a key one. How did free cash flow look?
It was actually an outflow, about $72 million. So roughly break even for the quarter.
An outflow, why was that?
Well, it was largely expected, mostly down to that 4-week work stoppage they had at Pratt back in May.
Ah, right. The engine facility.
Yeah. They expect to recover most of that in the second half, though.
Yeah.
Plus, you had about $250 million for the powder metal compensation.
Okay, that specific engine issue cost?
Right, an anticipated item. And another $175 million cash hit from tariffs in the quarter. So, yeah, an outflow, but with some clear drivers behind it.
But despite those headwinds, the demand picture sounds, well, really strong.
Exceptionally strong. The Q2 book-to-bill ratio was 1.86.
Wow, 1.86. So for every dollar shipped, almost $2 of new orders came in.
Exactly. That's huge. It feeds into their backlog, which is now sitting at $236 billion.
$236 billion, that's up, what, 15% year over year?
15% year over year and 9% just since the last quarter. Huge momentum.
Any specific big wins driving that?
Well, Pratt booked over 1,000 GTF engine orders, think Wizz Air, Frontier, and Raytheon, the defense side, pulled in over $5 billion in integrated air and missile defense awards.
So the underlying story is demand is booming, even with some operational bumps.
That's the key takeaway from the snapshot, absolutely. Which, sets us up nicely to dig a bit deeper into the financials in their updated outlook.
Okay, let's do that. So despite the strong quarter, how are they seeing the rest of the year? They updated their sales guidance, right?
Yeah, they did. They actually raised the full-year adjusted sales outlook, now expecting $84.75 billion to $85.5 billion.
Up from 83 to 84 billion before. So what's that, about 6-7% organic growth now?
That's right. A decent bump up in expectations.
What's giving them that extra confidence on the sales side?
It seems to be coming mainly from the commercial channels. They now see commercial aftermarket growing low teens for the year.
Up from around 10%.
Yeah. And commercial OE new equipment, they see that growing high single digits now, up from mid-single digits before.
Okay. And defense?
Defense outlook is holding steady at mid-single digit growth for the year. So the uplift is really driven by that commercial strength.
Interesting. But then the adjusted EPS guidance actually came down slightly from $6.15 to $5.80, $5.95. It seems counterintuitive. More sales, less EPS.
It does on the surface. The main reason they gave was a bigger hit from tariffs. They're now expecting a 30-cent headwind from tariffs for the full year.
30 cents? That's significant.
It is. But they did say they're offsetting about 10 cents of that through better operating performance.
How so?
Things like profit growth at Raytheon and better volume flowing through at Pratt & Collins. So internal work is mitigating some, but not all, of that external tariff pressure.
Okay, that clarifies it. Now, what about free cash flow? With the Q2 outflow and the tariff headwinds, did they adjust that outlook?
Surprisingly, no. They maintained the full-year free cash flow guidance of $7 billion to $7.5 billion. Really?
How are they managing that, especially with higher tariff impacts?
It's a bit of an offset story. The tariff cash impact, maybe $600 million for the full year, is expected to be largely offset by better cash taxes.
Ah, tax benefits helping out.
Exactly. Thanks to that recent legislation on R&D expensing we'll probably touch on later. So one pressure is balanced by a benefit elsewhere, keeping the overall target intact.
And they have confidence in generating that cash in the second half.
Seems so. They pointed to segment profit growth, working capital improvements, especially recovering that Pratt work stoppage impact, which is about $1 billion, mostly hitting Q3.
$1 billion just from the stoppage recovery.
Roughly, yeah. And then there's timing on the F-135 contract awards too. So it looks like a clear path operationally to strong H2 cash flow.
Let's talk more about those tariffs. They called the trade front fluid. What's the latest there?
Well, the news is actually a bit better than feared. Their initial estimate for tariff costs was $850 million for the year. Now they're saying it's closer to $500 million.
Okay, so a $350 million improvement. Where did that come from?
It's a mix. Some tariff rates came down or got paused, but they also highlighted their own mitigation efforts are working better than expected.
What kind of mitigation are we talking about?
Things like expanding their use of the USMCA, the North American trade deal, qualifying more parts for military duty-free status, using free trade zones effectively, and also some pricing actions.
And crucially, are these tariffs hurting demand?
They were very clear so far, no bleed through into demand. They seem confident the commercial aftermarket strength isn't being impacted.
Okay. And the Q2 specific impact was?
About $100 million in higher costs on the P&L, roughly 60 at Collins, 40 at Pratt. And the cash outflow related to tariffs was $175 million in the first half.
Right. And you mentioned tax legislation helping the cash flow outlook. Can you elaborate on that?
Yeah, this was a pretty big positive they highlighted. The new law restores full expensing for R&D costs and keeps the corporate tax rate at 21%.
So good news for R&D investment.
Definitely. Sure. And financially, for this year, it provides a moderate cash benefit offsetting maybe 25-30% of that tariff cash headwind.
Just moderate for this year.
Yeah, but the bigger impact is longer term. They see it as a sustained cash benefit in 2026, 27, 28. Helps competitiveness for U.S. companies overall.
Okay, so pulling these financial threads together, it shows management is actively managing these external pressures, right? Using operational levers and benefiting from some policy tailwinds.
Absolutely. It paints a picture of active management, not just being subject to the environment.
Yeah.
Which leads us nicely into their strategic progress and how they're executing operationally.
So how are things looking on the ground, starting with commercial aerospace?
Well, OE production making parts for new planes was strong in the first half, and they expect that ramp to continue.
And the GTF engine situation, that's been a focus.
The financial and technical outlook there is consistent, they said. Operationally, they pointed to a 12% year-over-year increase in isothermal forging output. That's a key process.
Okay.
And maybe more impressively, PW 1100 MRO output maintenance and repair was up 22% year-over-year in Q2.
22%.
Yeah.
Even with the work stoppage.
Yeah, pretty remarkable. Shows they're finding ways to boost throughput despite challenges.
And the goal is to get those grounded planes flying again, right? The AOGs.
Exactly. They're targeting over 30% MRO output improvement for the full year. That's what they need to really start bringing down those AOG numbers significantly in the second half. That's critical for their airline customers.
What about the older engines like the V2500? Still important.
Very much so. Still showing real strength. Only a 1% retirement rate so far this year. They expect it to remain a strong contributor for a long time, even if shop visits eventually taper off.
Any new tech coming for the GTF?
Yes. They mentioned the GTF Advantage production has started deliveries later this year, and something called the Hot Section Plus package.
Hot Section Plus.
Yeah, it's about 35 parts, gives you roughly 90% of the durability improvements of the full Advantage package. That starts going into the MRO shops next year. Should mean significantly more time on wing for those engines.
Okay, big focus on improving current fleet performance. Let's shift to defense. What's the story there?
Demand is just unprecedented is the word they used, driven by the need for air dominance globally.
And the U.S. budget situation helps.
Massively. That reconciliation bill provides over $150 billion extra for defense. And importantly for RTX, about $50 billion of that is earmarked for things like advanced air defense, ammunition's core Raytheon territory.
And international.
Also very strong. NATO allies agreeing to boost defense spending to 3.5% of GDP over the next decade, focusing on integrated air and missile defense.
So long-term visibility there.
Definitely. And RTX is capitalizing, expanding partnerships like the deal with Spain for Patriot production.
We saw the strong book-to-bill earlier. Raytheon must have a huge backlog now.
Huge. It's up 25% just since the end of last year. Q2 book-to-bill was 1.35, and the rolling 12-month figure is 1.49.
Almost 1.5. Incredible. What systems are driving that?
It's really that integrated air and missile defense portfolio. Things like Patriot NASAMS, Coyote, SM-3s, tail-8 components, high-demand systems right now.
Are they able to actually produce all this? Can they ramp up fast enough?
They're trying. Production rates for GMT rockets and Coyote drones are more than doubling this year. AMRAAM missile production is also ramping significant.
How?
They're investing about $250 million in capacity, hiring people, pushing the supply chain. They said it's their 9th straight quarter of material growth in defense output.
And are margins improving in defense?
Q2 margins were strong at Raytheon, helped by a good mix, more foreign military sales and direct commercial sales, up about $500 million combined. And more international work in the backlog generally carries higher margins.
What's the target margin there?
They're aiming for 12% plus. So clearly expecting profitability to improve as they execute on that massive backlog.
Beyond just building current systems, what about innovation? Anything new catching your eye?
AI and autonomy are big themes on their tech roadmap. They specifically called out a new partnership with Shield AI.
Shield AI, what's that about?
Integrating AI for sensor and target recognition into some Raytheon products like loitering munitions and targeting systems, making them smarter, basically.
Interesting. Any other key partnerships?
Yeah, one with Kongsberg, the Norwegian company, to co-develop parts of the GOSI radar.
GOSI. Tell me more. That sounds intriguing.
It adapts core tech from their existing ELAMS radar into a smaller 360-degree system. It's designed specifically to detect trickier targets like drones and cruise missiles. Builds on Kongsberg's proven NASAMS system.
So it's about adapting proven tech for new threats. How does that partnership give them an edge?
Well, it lets them leverage Kongsberg's expertise in existing platforms like NASAMS to bring this advanced capability for drone and cruise missile defense to market potentially faster. It fills a critical gap.
Gotcha. And internally, they mentioned a digital backbone using AI and data analytics.
Right. It's a proprietary platform connecting everything enterprise systems, factory machines, product data from the field. The goal is efficiency.
Can you give a concrete example? They mentioned Collins Avionics.
Yeah, they said Collins is using it to cut software development times by about 30%.
How does that actually work? How does a digital backbone do that?
Think of it like this. Instead of working in silos, engineers can use this platform to simulate software changes against vast amounts of real-world data instantly. They can test iterations much faster, find bugs earlier, reduce physical testing.
So it speeds up the whole design and test cycle using data.
Exactly. Data-driven efficiency, from design right through to manufacturing and support.
Okay. And quickly on portfolio changes and capital return.
They're sharpening focus. Agreed to sell the Collins Simmons Precision Products unit for $765 million. Already closed the $1.8 billion sale of the actuation business, using that cash to strengthen the balance sheet.
And returning cash to shareholders.
Big focus there. Raised the dividend 8% this quarter. They highlighted they expect to return $37 billion to shareholders between the merger date and the end of this year.
$37 billion. That's a serious commitment.
Shows confidence in the long-term cash generation, definitely.
Okay, so let's try and pull all these different threads together. When you look at the whole picture for RTX now, what stands out?
I think the biggest thing is navigating this complex environment, right? You have headwinds like tariffs, supply chain stuff, the work stoppage, but underpinning it all is just incredibly strong demand.
In both commercial aero and defense, that dual engine seems key.
Absolutely. Commercial recovery meeting this huge defense upcycle. It provides a really robust foundation.
And it feels like management is focusing on what they can control within that environment.
Exactly. Execution on the backlog, cost discipline, pushing innovation, mitigating those tariffs where possible. That seems to be the playbook.
And the long-term cash flow story looks solid, despite the near-term pressures.
Yeah, they seem very confident there. If you adjust for some of those one-offs like the powder metal costs, operational FCF is already tracking well above 100% of adjusted net income this year.
And looking ahead,
they expect a significant tailwind to free cash flow over the next few years, driven by growth, Margin expansion. Remember, Pratt aiming for mid-teens and those structural tax benefits from the R&D expensing.
So it's not just riding the wave, they're actively positioning themselves strategically.
Right. Through innovation like the AI work, the new radar, and refining the portfolio, they're aiming to be positioned for the next generation of aerospace and defense, not just the current cycle.
Okay. That brings us to our This Is Not Financial Advices segment. Based on all this, what's an outrageous but plausible trade idea?
All right, disclaimer first. Definitely not financial advice. Purely an idea based on the discussion.
Right.
So the idea might be a long position on RTX, but framing it specifically as a really long duration play, a bet on global rearmament and advanced air defense.
Okay, long RTX. What's the outrageous part?
The outrageous conviction is that this defense supercycle driven by geopolitics, budget increases, NATO commitments will ultimately overwhelm any noise from commercial air supply chains or temporary tariff issues.
Betting the defense story is that strong. What's the rationale?
Look at the evidence. That $50 billion in the U.S. budget for systems RTX makes. NATO hitting 3.5% GDP spending, Raytheon's $63.5 billion backlog with that 1.49 book-to-bill.
That demand signal is hard to ignore.
Exactly. Plus, they're investing to ramp production, the international mix is improving margins, and they have both proven systems like Patriot and new innovations like Ghost Eye. It feels like a multi-year tailwind.
So the catalyst is just the steady conversion of that massive defense backlog into revenue and profit.
Pretty much. That plus Raytheon potentially exceeding that 12% margin target and the multi-year cash benefits from the tax changes kicking in. It's a bet that the market eventually rewards that long-term, sticky defense revenue stream.
Any way to hedge that, hypothetically?
Well, for someone sophisticated, maybe a tactical short against a pure-play commercial supplier who lacks that defense diversification. Or maybe even a regional airline, heavily reliant on those older GTF engines facing near-term AOG issues. Just ideas to offset the conviction, perhaps.
Okay, an interesting angle, definitely plausible given the trends. Let's recap the key takeaways then.
Sure. Solid Q2 overall for RTX. Demand and backlog strength are undeniable, really across both commercial and defense.
Management seems proactive in tackling headwinds like tariffs and the GTF issues.
And the long-term growth path looks clear, driven by both market tailwinds and internal execution, particularly in defense and cash generation.
So, here's a final thought for you to ponder, building on everything we've discussed. How might RTX's big push into integrated digital tech and AI things like Ghost Eye, the Shield AI partnership, that internal digital backbone, how might that fundamentally change them over the next decade?
Could it shift them from being seen as just a traditional industrial giant to more of a tech-forward aerospace and defense powerhouse, affecting not just products but efficiency, margins?
Something to think about. How deep does that transformation go?
Indeed. We hope this deep dive has given you some valuable perspectives on RTX's latest performance and outlook.
As always, we encourage you to reflect on these insights. Let us know your thoughts or suggest topics for future dives.
Thanks for joining us on Talk Tickers.
We'll catch you next time for another essential look at what's moving the markets.